This is Fintech Insider News. This week, we hear from Crowdcube about their new growth series initiative. 11FS Holdings are making headlines this week, and we'll get you the inside scoop. And it's finally here. Klarna officially files for IPO and launches a debit card, and we'll take a look. We'll discuss all of this and more on today's news show, so don't go anywhere.
This episode of Fintech Insider is brought to you by Fireblocks, the stablecoin infrastructure platform trusted by top global businesses such as Visa, BNP Paribas, Revolut, and more. Fireblocks powers over $100 billion in monthly stablecoin volume, helping PSPs, fintechs, remitters, and banks issue, move, and manage stablecoins, all securely and with built-in compliance. Get complete control to build your stablecoin strategy, manage liquidity, and on-off ramp in over 60 currencies, all at scale. Learn more at fireblocks.com.
Hey, it's Paris. You know I love sparkly things, right? Like stars. Duh. And thanks to Hilton and AutoCamp, I just slept under them. Picture me, serving looks by the fire outside my luxurious Airstream, making s'mores with the kids, while a national park is our backdrop. The great outdoors meets Hilton hospitality. That's hot. Explore all the new ways to stay at Hilton.com. Hilton for the stay.
Hello and welcome to episode 995 of Fintech Insider, brought to you by 11FS, the 5-time consultancy of the year that works with banks, investment firms, digital banks, and fintechs to build the next generation of financial services. I'm Laura Watkins, Director of Media and Marketing here at 11FS, and this week, in a not much of a surprise given that I just said this was episode 995. We are very much focusing on our plans for episode 1000. So excited to bring those to you. And also a lot of planning going into our next After Dark event coming up at the end of September. And if you want to join us, tickets are available now. But it is September, which means back to school for many students. But is it also back to school for the world of fintech? As we return to our desks after what we hope was a long, hot summer break, those of you in the Northern Hemisphere anyway, we're here to bring you some of this week's top grade stories from the fintech space. And helping me do just that are 3 top-of-the-class panelists. Let's meet them. So first, we have a very big fintech insider. Welcome to 11FS Holdings' very own and friend of the podcast, Jamie Campbell, Deputy CEO at 11FS Holdings. Welcome back. We'll be hearing a lot more about your news shortly, but can you tell us a little bit more about Holdings and your role?
Yeah, sure. So over the last few years, we've been working on something quite cool, which we'll come on to. 11FS Holdings is effectively a joint venture between the brains behind 11FS and a European wealth manager that we've been working with for a couple of years now. And yeah, my role as deputy CEO is filling in on the operation and delivery side of everything that we're planning. Sprawls quite a number of verticals and businesses as well. Yeah, it's been an exciting time, and just coming back off of fintech summer. Yeah, I'm excited to kind of get back into it, and yeah, we've got some really cool shit to share over the next few months.
Definitely, some of which we're going to dig into very shortly, so stay tuned. Mm-hmm. Next up, we have a Fintech Insider return for Matt Cooper, co-CEO at Crowdcube. Welcome back to the show, Matt. Could you tell us a little bit more about yourself and Crowdcube before we obviously get into your news later in the show?
For sure. Thanks for having me, Laura. It's great to be back. I think it's 2 years or thereabouts since I was last on. I guess quite a lot has happened since then. In terms of our business, we've grown steadily and consistently since that point in time. And the private markets have been on a little bit of a tear over that period as companies have sort of ceased to go public, remained private, sourced and turned to different sources of liquidity, such as secondaries, which I know we're going to talk about a little bit later. But we've now raised about 1.5 billion sterling for nearly 1,500 companies, including lots of the fintech. I'm not sure if they're glitterati or Illuminati, but the Monzos, Revoluts, Contos, Moneyboxes of the world. We've established the business as the sort of go-to platform for companies seeking to involve their customers as shareholders in Europe. And on top of that, we're kind of adapting and evolving our product to positive changes in regulation, particularly in the UK, and changes in investor and company behaviour as well. So we'll talk a little bit more about that later.
Definitely. Well, congrats on a very busy 2 years and good to have you back on the show. And we'll dig into all of that very, very shortly. And finally, rounding out our panel, we have a Fintech Insider debut for Mike Curtis, co-founder and CTO at Multiply.ai. Welcome to the show, Mike. Could you introduce yourself to our listeners and perhaps tell us a little bit more about your role and Multiply?
Yeah, absolutely. So, I'm Mike. I co-founded Multiply now almost 9 years ago. So we're an AI company from before AI companies were cool. We focus on automating financial advice. Originally, we did that B2C. These days, we're B2B. So we offer it for financial advice firms, banks, product providers like big insurers, and increasingly some of the challenger banks as well. My role as CTO is basically, I'm still in charge of all the technology. I still get involved in, I still get hands-on building every day. But increasingly, I'm looking at how we incorporate all of the new advances in AI over the last couple of years in technology that is going to be useful for people looking to offer financial advice.
Amazing. And obviously at the speed that AI is moving, I'm sure there's a lot that you have to keep on top of all day, every day.
Absolutely, yeah.
Don't envy that job.
Exactly. But we'll be picking your brains on some of that. Yeah. Great. So we have our panel, and now let's start the news. So our first story, Fintech pioneers unite to build a bank for high net worth individuals. This story in Finextra, but also broken in the Sunday Times and various other places. Project Arnaud is a new venture led by Fintech veterans Jason Bates, co-founder of Monzo Starling and 11FS, and David Brear, Group CEO here at 11FS, and Max Koretskiy, co-founder of Black Shield Capital, and Jamie Campbell. Modernizing wealth services, the founders point out that while retail banks like Monzo and Starling are advanced, private banking remains archaic, filled with hidden fees, sluggish account opening, and outdated reporting systems. Project Arnaud currently has £50 million earmarked and will be opening another funding round soon. Jamie, obviously great to have you here. There's no point me telling the listeners about it. How about you give us a little bit more of a rundown on this announcement?
Well, it's a really good intro. It's a very good intro.
Well, you're welcome. But maybe you take it from here and tell us more about it.
And I think it covers quite a lot of ground. I mean, anyone who has experienced the archaic world of the archaic wealth world, shall we say, whether it be private banking, whether it be old school wealth management, there's not a lot of technical interface in it. Often it's very service driven, very people led, relationship led, and digitizing those experiences hasn't really been top of the agenda for a lot of people. And for a long time, 11FS has been talking about how this is the final wave, really, of where fintech can have a massive impact. Where technology can make wealth services more attainable for people with less cash. Because really, the equation that is making things difficult is wage inflation is increasing. So the cost of offering these wealth services to wealthy clients is becoming higher because people want and expect higher salaries. But fees are relatively stagnant. So they're always being squeezed and squeezed and squeezed. So, big banks who service these clients are looking for wealthier and wealthier people. And it's kind of creating an environment where the investing in technology to make that easier is becoming more difficult. And so there's this big gap we see, which is servicing clients, up to around about £5 to £8 million of investable assets, where, we could really make a massive difference. And the opportunity area, as we see it, is exactly that, offering private banking services to these individuals who have financial lives that are much more similar to that of a small business than of a general retail client, and offering wealth management solutions that are both personal, but also able to be to outperform, a managed account or an advised account as we see it, and be very transparent about the fees that we charge. So, we see a big opportunity in this space. And yeah, as I said earlier, we got kind of tired of telling other people that they should go and do it, and we've kind of gone and done it ourselves.
Amazing. Well, yeah, it's very exciting to see this news come out. Obviously, you had a sort of coverage in the Sunday Times over the weekend and sort of trickle down across this week. Kind of one of the points of the plan was around acquiring existing businesses. Can you tell us a little bit more about the sort of opportunity space there?
Yeah, I think when we kind of looked at how we would, in an ideal world, how would we attack this market? And the general fintech growth plan is always start with a small MVP, gain some traction with initial clients and start expanding the product features and kind of build from there. So starting with something that's relatively uncomplicated and one-dimensional. But this market, these clients expect quite a high bar when it comes to service and when it comes to capabilities on offer. They want banking services, they want, credit offering, they want, assistance with their investments and advisory services. And, our approach is that we want to be able to go into the market with a broad suite of capabilities. And so what we've done is we've looked across the market to find businesses that are capable of helping us get to the to that offering quicker. Businesses whose models we don't have to change too much, whose strategies are quite aligned to that approach already, who have existing clients, with a little bit of 11FS technology magic and a beautiful application to wrap those experiences all together. Could create a new player in the market. Unified under a single brand, and that's really what Project Arnaud is. It's that is not our branded offering going into market. We're still working on that, but really, it's about bringing those multiple services together to challenge the big players in the market with something new and fresh.
Awesome, thank you, Matt. I'd love to get your take on this. Obviously, you've worked with some of the, the big retail brands as we know them now, but maybe back in the day when they were a lot smaller and just starting out. What's your take on this? Do you think there might be like a sort of trickle down effect here, and is this sort of taking the right approach?
Yeah, I think it's super interesting. I read the article in the Sunday Times, and hearing Jamie talk about it in more detail has been great. I think one of my questions you kind of answered, which is, I think there is an expectation that a number of different people can build really big wealth tech businesses or wealth advice tech businesses in the UK and Europe over the next few years, given all of the advances in AI that we're seeing and how that can trickle down into that product offering. But the bit that historically people have struggled with has been really expensive people are really expensive to acquire from a customer perspective. So understanding that kind of buying model as opposed to the build MVP, start slowly, build community, acquire customers. I think that's interesting because they are super expensive individuals to acquire, and they are super difficult individuals to shift from incumbent services and advice. They're naturally not mobile. They don't really wish to be mobile in terms of advice. If you've been using the same service with your Swiss bank or your Italian bank or your IFA in the UK, your propensity to churn to somebody else is pretty low, to be honest. So the product needs to be absolutely mustard in order to get somebody to move. I'll talk about the trickle down in a second. I think one of the most pressing questions I've got for Jamie is whether him and David and the team are going to take a more progressive approach to building a private wealth business or a private banking business and involve their customers as shareholders along the journey. I know a company that can help with that, if I'm honest. And I think that built for the audience, by the audience, could be quite interesting, but we can talk about that at a later stage. I'd love to hear your thoughts, Jamie. I'm putting you on the spot here. In terms of trickle down, I actually think about it slightly differently, and I think about it as trickle up. I'm not entirely sure you can trickle up, But I think there's a whole host of innovation that's happened in the retail banking space with all of the names that we know and love, that can trickle up into the wealth management space and hasn't yet. So I think it's less about what could Monzo or Revolut or Crowdcube or Moneybox learn from innovators in the wealth advice or wealth management space, but rather what can trickle up from what's already happened in the retail banking space.
Yeah, Matt is absolutely correct. There's a couple of points that I'll answer. I think you're right. There has to be on the kind of bringing clients away from their existing providers. There has to be a combination of of pull factors, and there are a number of push factors that that are just clear. Number one, fees. All we have to do is look at a certain financial advisor or franchise financial advisor company in the UK to see that fees are an absolute nightmare, and people are trying to get away from that. We are aware of a number of banks that service this type of client who are actively looking to offboard individuals who have some wealth, but not necessarily enough for them to break even on a per client basis. We call those people the poor rich, the people who can't get the platinum service that that these banks are built on, and so they're just looking for somewhere to put them and treat them fairly and say, look, you don't no longer qualify, but here is a viable alternative, coupled with pull factors around an incredibly well-worked product that is there to solve the needs of these particular individuals. So whether it's just in the onboarding process, I'm a time poor, wealthy individual, and now I have to, spend a number of minutes going through all of this onboarding. Why can't I just hand it over to my assistant to help me do that, as opposed to doing it myself? I've got a complex tree of balance sheets that I want to keep on top of. A house in another country, rental properties in the UK, dependents, and all sorts of other individuals who I want to provide accounts to. You see this kind of structure in small business banking arrangements, and we think that there's a real place for something like that in the private wealth spaces as well. And I think one thing that we've learned from the challenger banks, something that they're incredibly good at, is preventing you from speaking to someone. It keeps their cost bases incredibly low, which is exactly what those businesses need. But what we've learned from the robo space is that people who have this higher level of wealth, they could just put their cash into a robo, but they don't. Why is that? Well, because they like to have that personal, white glove experience where someone is there looking after their money, providing them that feedback and in some cases that advice. And being able to marry those two things of having extremely good technology to make this an incredibly low cost to serve product, but also being able to connect people to their advisors incredibly easily through the product is where we see some real cool stuff can happen. And exactly as you say, Matt, providing those individuals with private market investment opportunities that they can't get in the open market is going to be an incredibly interesting area that we would love to be at the forefront of, because ultimately it's another pull factor to get these people in. And if we're building digital products, then our audience will arguably skew younger, have a slightly different risk criteria than kind of the established wealth market is serving, and probably more open to these different products, whether they be in crypto, whether they be private market secondary sales, or whatever it is. There will be a growing market for these new opportunities, which we want to be right there, providing the interaction layer, shall we say, to those opportunities.
Thank you. love to bring you in, Mike, obviously, with your CTO and tech hat on, but also looking at that kind of advice space as well. What's your kind of take on this? Obviously, you focus predominantly on AI. Private banking is usually kind of built on that exclusivity, the trust, the sort of very personalized service, but usually from a human. Kind of what role can AI play in this space and still be kind of, as Jamie said, considered like a value add to the client base they're going after?
Yeah, you hit the nail on the head there where you were talking about trust. We saw this when we were B2C. You can provide great advice, you can provide a great product. And we very early on automated financial advice, direct to consumers. But we provided a human-based service as well, or at least a number that people could ring to talk to a human advisor. And the big thing we got through from that was people calling up and just asking for reassurance. They weren't necessarily challenging the automated advice. They weren't necessarily disagreeing with it, but they wanted that human-to-human reassurance. They wanted someone saying, yes, this is the right thing to do. And I think so much of, how we evaluate services where we have to make a big decision, something like, private wealth, you're making a big decision. It's not necessarily one you can unwind easily if it goes wrong. You're not going to be shopping around loads. We've heard these people are big sticky. So how do you go about evaluating, this is where I want to put the money? Well, you look at the person, you look at the tie, you ask them questions, you ask that, you look at the paper that they printed stuff out on. I was really dismissive of this when I started out the business. I thought, with all the kind of maybe naivety of someone straight out of uni, that, the kind of paper you print stuff on, all this was sort of, the hallmarks of an industry that was kind of was ripe for disruption, maybe. But I think it's really, the longer I've gone on, the more I've understood how important it is to nail those things. Now, I think the good news is the new brand of AI, generative AI, the power of LLMs, it can go a long way to, if not completely replacing humans, then at least turbocharging their ability to, react to the right kinds of customers, to maximize the time of the humans you kind of have who are going to get involved, who are going to form those personal relationships, who are going to be important for building that sticky business and getting those people to trust. There's loads of opportunities there for maximizing it. But I also think it has to go hand in hand with, I think, a deeper understanding maybe of what motivates these individuals to trust the services that they use. And I think it's always going to be about maximizing the impact of humans, which you're going to have to keep around to form those bonds.
Definitely. So we're basically out of time on this one. I realize we probably could talk about it for most of the show, but we do have other news to cover. Jamie, as a final word, if you needed the audience to take one thing away from this announcement, what would it be?
Gosh, that's a tough question. Probably just follow along. We kind of broke ground, I guess, on this story at the weekend, and we have a lot of news to share over the coming months. And a lot of the content you're going to see from us is probably focused around bringing together the right team to pull it off. So if you are in this space, if you are a product builder, or if you're dissatisfied at one of the businesses that we'd kind of mentioned, in the private banking space, and you think it could be done better, we do want to hear from you. You can reach out to me directly on LinkedIn, or you can send us a message on 11fsholdings.com.
Brilliant. Wonderful. And we will now move on to our next story, which is that Crowdcube announces launch of later stage investments. The story was on Crowdfund Insider and others. Europe's leading private market investment platform, Crowdcube, has unveiled a growth series designed to help late stage private companies unlock liquidity, either through new capital raising, secondary shareholder exits, or a blend of both, and to engage loyal customers as shareholders. As we had earlier, with over 12 years in operation, Crowdcube has supported early-stage firms, some of which have become high-profile private companies such as Monzo, Revolut, and Quanto, helping them raise more than £1.5 billion from retail investors. Crowdcube positions itself as a lifetime partner for private companies from early seed to IPO candidates such as Moneybox and Chip. Crowdcube's growth series addresses demand from later stage firms that may not require fresh funding but want to enable early investors or employees to realize value ahead of IPOs or acquisitions. So Matt, obviously, I'm going to come to you first on this. Hopefully that summary does it justice. But can you tell us a little bit more about what this looks like? How does it differ from kind of the business model so far? And kind of why did you take the step to focus on this later stage?
Yeah, I think there's a few moving parts there. I mean, the kind of origin story of why we founded the business was to raise small amounts of capital for small businesses from a small number of people. And as the business has evolved over the years, and we've moved up the value chain in terms of the size of company that we're supporting, this is just the next evolution of our product offering to meet the needs of the market as we see it today. And how's the market changed? Well, the market's changed because the traditional routes through to liquidity for late-stage private companies, namely IPOs, have ceased to happen. And they haven't happened for many years. There are some starting to happen, particularly fintechs in the US. One of our shareholders, Circle, just recently, big stablecoin business, recently IPO'd in the US to great fanfare, which was fantastic. But for the most part in the UK and Europe, where we operate, that source of liquidity for founders, employees, early shareholders has ground to a halt. With these companies staying private for longer, a lot of the value creation that was traditionally happening when retail investors or anybody could get exposure to these assets on the public markets is now happening while they're still private. So what we've done is we always come at this as a marketplace. You know, we have two sides to service. On the sell side, we have the companies, the founders, the employees, or the early shareholders who are looking for some liquidity. And on the buy side, we've got our big base of investors of all different shapes and sizes, from sovereign wealth down to people who invest £50, who want access to a slightly different stage of the asset class. So this kind of pre-IPO growth stage. Now, in some instances, we'll do that via primary fundraising. That's when a really late stage company is issuing new share capital and they invite our investors and often their customers to become shareholders at that point in time. But increasingly, we're doing more secondaries. And that's because the underlying company is profitable, doesn't necessarily require primary capital, but is interested in different sources of liquidity, either for founders, for a management team, employees, or just early investors who've been on the cap table for a really long time. So all of this has kind of come together at the same time as some relatively sweeping regulatory changes which are happening at the end of this year. The two big ones, as far as we're concerned, something you've all probably read about in the press a lot, which is the PISES private intermittent securities exchange framework that the London Stock Exchange Group have just been sort of gone public as the first licensed holder, PISES holder that can operate a private securities exchange. And additionally, a thing called the POP regime, which is called the Public Offer Platform regime, which means a private company in the UK or Europe can now raise an unlimited amount of capital from retail investors without producing a prospectus document, one line on the cap table. And to put that into context, an example I like to use is we go back and talk about like the Ask Sid campaigns from many years ago that if you're old enough, you're like me, you'll remember, where people were invited to, become shareholders of the post office. Or you have a scenario now from January the 1st next year where really late stage companies like Octopus Energy, for instance, 7-8 million UK customers, if a fraction of a percentage, a couple of percentage points of their customer base in the UK invested £1,000 in buying their shares, they'd be doing a £200 million growth round. We could do that in 3 or 4 weeks. No bankers, no advisors, no stock exchange, no public market listing, just quick, easy, hyper engagement with their customer base prior to them going public. So all of these things have come together. And what we've done with the Growth Series is we're able to label these opportunities and start educating investors as to why diversification of their portfolios away from just early stage tax efficient investing into later stage pre-IPO investing is advantageous and exciting. And on the company side, it's about education of founders of late stage companies to say there are alternative routes through to liquidity available to you. And some of them are pretty damn exciting, because you could invite your customers to become shareholders before you go public. You can free up some liquidity for employees, for early shareholders, often those are friends and family, and indeed for yourself. So we're super excited about it. Some of the regulatory changes which are happening in the UK haven't happened yet. They're happening at the end of this year. We can talk a little bit later about our first opportunity under the Growth Series banner, which is the big micro-mobility European unicorn giant Bolt that certainly our European investors have been really excited about, often because they're users of the product every day. And underpinning all of this is our technology and regulatory permissions, which are all in-house, which are proprietary, which are unique, and enabling us to do these massive secondary liquidity events where we might be going out to 10, 20, 30,000 shareholders of private companies and saying, here's a really neat way for you to sell some of your stock to either institutional investors or retail.
Amazing. Well, that was a comprehensive overview. Thank you. And also very exciting times. It sounds, it sounds good to me. Jamie, as former head of VC at 11FS, what was your take on this?
Yeah, it's great. I think one of the points that Matt touched on, but is worth spending a bit more time on as well, is with a slowing liquidity market in terms of exit potentials for venture capital firms, what that kind of does is it means that the release of those funds takes longer and longer, and therefore the ability to kind of redeploy that capital into the market or raise additional funds, to be active in the market becomes more and more difficult. So having more opportunities to realize that liquidity is just going to be great for the for the startup ecosystem, because there's just more opportunity to generate that liquidity to to kind of wash around and repeat the cycle. And I think in the UK in particular, with the with the London Stock Exchange not being entirely attractive for a lot of founder investors, I think having these kind of these side markets effectively where you can create those sort of private public market offerings becomes really, really interesting. When you add that together with the fact that the price of going public, the documentation that needs to be produced, getting a sponsor, all that kind of rigmarole, avoiding all of those trappings, I think makes this kind of very, very timely. And I think just certainly what the UK is desperate for. I think we could definitely go further. Don't get me wrong. I think there's a lot more that can be done. But yeah, I think this is great. And I think we've seen other businesses in the States. I think there are firms that have these kind of more private market offerings. But yeah, having something like this in the UK is going to be great. I have a question actually. You asked me a question. I've got a question for you. A later stage business obviously is going to look to raise, quite a lot of cash in some cases. And I guess engaging the customer base, which I think is absolutely correct. Who better to bring in than your biggest fans? Do you foresee there being a minimum investment criteria, minimum fund size or minimum, can you do it for £1? Like how do you, from an administrative perspective, what do you see being the kind of the operating model of this?
Yeah, I guess that's part of our secret sauce, is that all of the technology we've built over the years we've been doing this, and all of the regulatory permissions we've layered on over the years we've been doing this, mean we wouldn't blink an eyelid if Monzo did a secondary tomorrow morning and invited their customers to become shareholders once again, and 150,000 retail investors poured into the opportunity in 5 hours. Makes no difference to us. We wouldn't blink. The technology wouldn't skip a beat. Now, I couldn't have said that 10 years ago, but I can confidently say that today. I'll probably get a message from my CTO that I shouldn't have said that shortly. But No, one thing that, you touched on, Jamie, is that the government, the regulator, the London Stock Exchange, and, people like Mark Austin and Julia at the LSEG should be applauded for the pace of innovation that we're seeing around the loosening up and the pro-private market agenda. If we want to make the UK attractive for businesses and technology companies and fintech companies to go public, we need to make it attractive for them to remain private here until they do go public. And alongside that, we need to be better at financial inclusion. We need to have more retail investors who are less in cash and more in UK productive assets. And because a lot of our UK productive assets, like Revolut and Monzo and Moneybox, are not public assets, i.e. I can't go onto my, I can't speak to my advisor and get them to put a buy order in for a block of shares. Helping those businesses and helping those retail investors get access to these assets while they're still private is really, really important. And we're kind of in the middle of that, but there are a lot of people and a lot of organizations doing a lot of good stuff at the moment and forcing through regulatory change, which we think is really positive.
Awesome. And Mike, I want to bring you in. You were kind of nodding along as Matt was talking there. What's your take on this as someone that also works in that sort of advice space?
Yeah, well, I'm actually going to talk about it more as a co-founder and somebody who built a startup. But I think you're absolutely right, Matt, in terms of allowing companies to stay private until they can go public. And unfortunately, I think particularly for UK companies, the option isn't just going public; it's also being bought by a big player, typically not from the UK, not from Europe, who's going to come in and they're going to be able to realize the value of the shares, and that's going to look like an attractive opportunity. And I get a bit upset when I see that. I think we've got great business building skills in this country. We've got great, people who can build great businesses, and then going and seeing those businesses, only achieve their kind of final potential under the ownership of something, far outside of the UK, and then not seeing any of that last stage of the value. We're often, because of the nature of it, the actual multiples are huge, but all of the hard work has kind of, in my mind, already been done in those early years. So I think anything that gives those companies options, gives the founders and the seniors people at those companies the ability to, take some value out, settle things that they need to, allow them to justify continuing the business, continue growing it, continue taking it to reach its potential is a good thing. And I think kind of we just need more of that kind of thing to ensure that those really exciting businesses that are genuinely innovative and kind of have real potential stay in the UK, and we see more of the value coming back through the ecosystem here.
I guess the question I have is, let's just say I'm a client of Monzo. They've done this, they've done the secondary, and now I've got a private share. What can I do with that? And is there a full, a secondary market for myself to trade? And I think that is a very interesting proposition, which is. I don't know how far this new I need to familiarize myself, I think, with those regulations that you mentioned. But I wonder if you've got a comment on that as well.
Yeah, I mean, if you bought a Monzo share tomorrow morning, you'd have to hold it until they went public or had another liquidity event. But the beauty of giving everyday investors access to late stage assets is the fact they're late stage means they're that much closer to a liquidity event, be that whatever, be that a bigger bank coming to buy them or them ultimately going public. It's a long old journey. If you invested in Monzo in 2015, 2016, it's been a very lucrative journey, but it's a long journey. And Mike, you're right. For founders, we in the UK and Europe are becoming much more comfortable with the concept of secondary liquidity for private companies. It's much better understood in the US, where it's not weird. It's not the sign of a distressed company. It's actually allows you to focus on continuing to build your business, take some risks without worrying about your family's future and whether you're going to lose your house or not. So The last point I think, Mike, you mentioned is keeping that value in the UK. Like, why should a teacher's pension fund in Canada benefit from all the value creation that Monzo or Revolut or anybody else has done by remaining private in the UK, when a UK retail investor who may also be a customer of that company and help them get to the point they're at, not enjoy some of that benefit as well? So we're pretty passionate about it. Jamie, don't spend too many evenings awake reading up on this regulation. Unless you're in the space, it can be slightly dull. But the snapshot is, for us, it's super exciting. For retail investors, it's super exciting, and for private companies, it's super innovative and offers different forms of liquidity, and all of that is good stuff.
Cool. All of that is good stuff. That is a good place to end the first half of this show.
There you go.
On that note, we're just going to take a quick pause. Back shortly.
Raise the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. Start converting your B2B audience today. Spend $250 on your first campaign and get a free $250 credit for the next one. Get started today at linkedin.com/campaign. Terms and conditions apply.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider.
Before we get back into the news, I wanted to tell you about our latest Fintech Insider Insights episode, which is all about partnerships. We're all searching for the perfect partner, whether it's in life or fintech. And let's be honest, in today's fast-moving product landscape, the right partnership can make or break your success. They're no longer a nice to have, they are business critical. Whether it's scaling faster, accessing new markets, or simply building better products, teaming up is often the only way forward. And in our latest episode, Benjamin Ensor is joined by a brilliant panel of experts from Adyen and Google to explore what makes the perfect product partnership and how to keep the spark alive long after you found the one. Because in fintech, finding your match is just the beginning. This episode is out now. Just scroll down to the podcast right below this one. And now, back onto the news. And our next story is a much-anticipated headline. I think we all saw coming, but now it's finally here. Klarna has filed for their US IPO, but equally launched a debit card in Europe. This story in many places, we took it from Finextra. Klarna has formally filed for a US IPO, planning to list its shares on the New York Stock Exchange. In doing so, the company aims to raise between $1.27 and $1.46 billion US dollars, with a projected valuation of up to $14 billion. As if they weren't having a busy enough week, it has also introduced a new Visa-powered debit card in Europe where users can make payments using flexible options such as pay in full or pay later, all within the app ecosystem. The aim is to give consumers more control and transparency over payments when compared to traditional credit cards. And this new card is part of a broader partnership with Visa, enabling it to be used across the extensive Visa network, both online and in person. Obviously, as I just said, this Klarna IPO has been very much anticipated, so much so that we covered it all the way back in episode 891 of Fintech Insider News in August last year, so 100 episodes and a year ago. Here is a clip from Sarah Kocianski, at the time CEO of Fintech Wales.
Well, they've been open and clear that an IPO is very much on the agenda. I think the question is, what are they trying to build? What are they trying to do with it? It's growth. Is it growth of revenue? Is it growth of customers? Because all those things are going to be really scrutinized if they choose to IPO. So it's a case of what are they trying to achieve with this, which means they've done it now. as opposed to after they go for any kind of fundraising or exit or whatever it is they're choosing to do next. So I think that's going to be interesting to watch, to see what's their goal.
Okay, so here we are back in September 2025. What do we think is their goal? They announced an enormous fundraise. Their revenue has climbed. They've got 111 million active users. What do we think is going to happen at the point of IPO? Maybe let's come to you first, Jamie.
Yeah, I think it's. I'm quite excited about this because I think it's the bellwether for for a Revolut, up and coming IPO as well. I think that.
Do you think this is the first domino to fall, and then the others will follow?
For me, I would be watching this incredibly closely. These fintechs who have these, gigantic user bases, larger than many than all the big banks that we whose brands we all know. So these guys, Nubank, Revolut. I think it's going to be incredibly interesting to see what happens the 6-12 months after this IPO, the performance of those shares post listing, and I think that metaphor of the dominoes falling, I think is potentially be, maybe you'll get you and I our little voice clip in 50 episodes time or however many episodes time, and play with some other great guests, and we'll be proven right. But yeah, I think it's very interesting.
Let's see. Mike, what was your take? Obviously, you kind of expressed disappointment in kind of these fintechs choosing to IPO outside of the UK, which Klarna has very much nailed on from the beginning. What's your take on this? And kind of what about the timing? They kind of started in April, then they rolled it back with there's all the tariff news, and now they've decided now is the time. Is that significant, do you think?
I think it's interesting because, obviously on the other side of things, they've made so much buzz about AI. They've talked an awful lot about, how they've massively reduced their workforce, how they're really embracing it. I think there was a lot about that narrative that felt like they were gearing towards this. And I think at the same time, there's potentially reasons to be, to think that there won't be a better moment. I think that all of these businesses, a lot of the challenger banks included, a lot of them are kind of based on sort of credit model. Obviously, buy now, pay later. That's always a I think, systemic risk, and probably, I think Klarna's done really, really well. I think it's for me. I think it's probably difficult to think about how much better it could do at that, particularly given kind of the macroeconomic circumstances. So the obvious route is, okay, well, let's make the most of that massive user base. Let's move into debit cards. Let's move into some of the other services and cross-sell across. How successful will they be at that? Well, it's interesting because unlike things like the challenger banks, where they came in, I think, with a really, really, consumer-focused, feeling like the good guys, I guess, against the kind of banks. Klarna, I think, has been much more of a transactional kind of product. It's very much like, we give you these products when you want them, and we deal with the kind of messiness of the credit. Does that translate to a kind of deeper relationship with your customer in the way that people like Monzo, who've really went out their way to I think feel like they were involving their customers? We've already talked about crowdfunding, but things like that. I don't know. So I think the timing makes sense. I think I think if they wait much longer, the kind of the moment, I think, will have passed. And I think that there are, they've done really, really well. They're an interesting business, but I think behind some of the AI stuff and some of the noise, I see potentially quite big risks for a business like this.
Yeah, it's interesting as well, because when Trump came in, everyone was expecting it to be 4 years of just like crazy IPOs, stock market going ballistic, drill baby drill, et cetera, et cetera. But, tariffs, and the economy slowing down is what we're seeing. And, you picked up in particular about the business model of Klarna being, credit based. And, the 2 to 3 year effects of, the ripple effects of those tariffs and that economy slowing down, whatever happens when, at the end of Trump's term, whoever is there, is it going to be as poppy in the stock market, and will those tariff effects be realizing in the real world? Will those real person impacts be being felt? So from a timing perspective, maybe this is it. Because you do it in a couple of more years and maybe the numbers aren't so good.
So
and
you
maybe
jump now, maybe rather than wait and miss your turn.
Potentially, I'm sure they've paid a lot of money to get good consulting around when they should be doing this. So it won't be an accident that it's now. And so those reasons are either capitalize on the opportunity of an absolutely banging stock market, or if you want to get liquidity in the next 3 years, actually this is the time to do it, because maybe macroeconomically it's not going to be as great in the next few years with what we're seeing as the shakeout of all of these, relatively unpredictable policy changes.
Yeah, Matt, what's your take on that, on like the kind of timing and the opportunity space? And is there something to be said for being the first domino? Like, does that add any benefit to you or not? Or is it better to kind of be the one that goes second, having taken learnings from the first?
I'm not sure I agree with the whole domino statement.
No? Okay.
I'm
Tell us
not
why.
sure how much of a leading indicator Klarna listing in the US is for a new bank or a Revolut. Like, they operate in a different level of the atmosphere. Those companies have an abundance of private capital still available to them. You put Stripe in that bracket as well. There is no requirement for them to go public right now. There's as much primary or secondary liquidity as they could ever possibly need, and they're profitable anyway. So why the rush to go public? I don't think the teams over there will be watching with bated breath at how the listing goes for Klarna in the US. I hope we don't see the first day pop that we've seen recently, where basically employees and founder and early shareholders get shafted and the bank's clients reap the benefit of it being mispriced. I know if you ever follow Bill Gurley in the US, he's very vocal on the absurdity of that situation, but he's also been very vocal on that's why the Stripes of the world and the Revoluts of the world are staying private, because they get to set the terms. They do it on their timeline. They can do it privately for the most part. And that for them is more attractive at the moment. I think the other crying shame is our inability to manage a listing like this in the UK or Europe, and that it has to go to the US. Is that ever going to change? I don't know. As I said previously, there's a lot of innovation happening in the UK right now, in and around the private and public market interface. But until the capital allocators in the UK, I mean, the really big ones, the pension funds and so on and so forth, are more comfortable pricing risk and pricing a business like Klarna when it goes public, I don't think we're going to see another Klarna list in the UK for a while.
And Jamie, kind of building on Mike's point around Klarna's movements in Europe, starting debit cards, etc., trying to cross sell. They have this enormous kind of user base of 111 million. They're partnered with Visa. That's obviously a pretty big partnership there. Are they trying to become a challenger bank without actually saying so? Like, what's their game plan here?
Well, I think Mike was right to call out obviously it's not a super fragile business model. They're an incredibly successful business, but every fintech owner, when they go to bed at night, they close their eyes and they dream of being a bank, because arguably it is the terminus of a lot of innovation. Where do you go next? What are we going to, what features are we going to offer our clients? What products are they crying out for? generally speaking, the trend pushes you in that direction. I remember in the early days when talking to Tom Blomfield about go cardless, he was like, "Well, actually, the business I want to make is a bank. Not necessarily go cardless, because all the features that we want to offer require that level of regulatory scrutiny, but also holding cash, moving money, like providing that level of service." So potentially this is them on that journey. I think as a sidebar, I think it's great to see Visa winning a big gig like this. I know MasterCard have kind of had a big swing across a lot of the challenges. So it's kind of good to see their investments in some of their newer products kind of working out. Like I said, I think it's the natural progression of a lot of fintech businesses is that they start thinking, let's put cards in markets and let's become a bigger part of our clients' financial world.
But that's interesting, right? If for Klarna, for instance, if you look like a bank and you smell like a bank, at what point are you going to be valued like a bank? And I wonder whether you go too far one way and too far towards, like, I look and feel like a traditional bank, therefore I'm going to be valued like one.
Interesting. We will have to, I guess we'll have to wait and see. They, as we said at the top, they're trying to get a projected valuation of $14 billion. Whether they get that or not remains to be seen, but we will obviously keep an eye on this when it actually does list and how its sort of initial floating does, and we will keep you updated. But yeah, this has been very hotly anticipated across the last year, clearly, if we've covered it all the way back in last August. So we will see how this one turns out. And maybe, we'll be quoting you guys on the next episode when we do. Going to move us on to our next story, which is that Xero has launched an AI Superagent. Xero has launched new features for its AI Superagent JAX, or JAX, designed to automate tasks, deliver insights, and adapt to each small business's unique operations. JAX replaces scattered tools with one intelligent interface, automating workflows like bank reconciliation and data entry while keeping users in control. It provides proactive, actionable financial insights by analyzing business data and leveraging OpenAI's web research for real-time information. With growing demand for AI, 73% of Xero users have already adopted it, and over half of surveyed US small businesses plan to increase their AI investment to stay competitive. To tell us more about this launch, we have a voice note from Chief Product and Technology Officer at Xero, Diya.
JAX allows us to reimagine the entire customer experience in Xero to be one that is more intelligent and personalized. Instead of many disconnected tools and experiences, JAX provides one intelligent interface to unify your entire business, learn your rhythms, automatically adapt and create an experience that is unique to you. JAX automates manual tasks and workflows like data entry, bank reconciliation, and getting paid, completing them in seconds with accountant-level accuracy and appropriate oversight from you or your advisor. This true just-done automation helps you move faster, stay compliant, and scale effortlessly. JAX also moves beyond static reports to deliver actionable insights that move the needle. It leverages trusted data from your business, the web, and apps to deliver personalized, timely insights. With a unified view, JAX spots opportunities and issues, helping you move faster and make informed decisions.
Well, thank you to Diya. Mike, I'd like to come to you first on this one as our AI expert in the room. What's your take on this, particularly around the sort of just done view on automation and kind of like what is the sort of, as we talked about earlier, the kind of human versus AI impact here?
Yeah, I think as ever with AI, you've got to pick through the PR a little bit to understand what's actually what's changed. I think this is as much an opportunity to make some product changes. I think there's obviously the developments that have been that they mentioned, things like OpenAI being able to use that to go off and search for the latest data. But I think actually this is a product reorganization of pulling a bunch of features that probably existed in some form in various different parts into a single place, and probably throwing in a bit of AI glitter to kind of improve things, and to give the customers a little bit of a feel of something like ChatGPT. But I think that fundamentally, the kind of idea of just done automation that completely replaces an accountant, for me, is a bit of a fantasy. I think that there's obviously a huge amount that you can do with automation. You can take away lots of painful, boring work. You can, the kind of busy work, which in accounting, there's a reasonable amount of that. But there are a whole bunch of decisions, particularly with large companies, where when it comes to accounts, if you get it wrong, people potentially go to prison, right? People potentially, people's liberty is potentially on the line. And now, obviously, that sounds a bit dramatic, but I think that the real risk with sort of wholesale adoption of AI tools and the idea that we can just sort of outsource it all to AI really risks making the whole sort of industry being, robots kind of reviewing the output of other robots, reviewing the output of other robots. It doesn't get to the bottom of actually what we're trying to do with accountancy, which is properly scrutinize businesses, look at them as individual businesses, understand their risks, understand how they're doing. So I think this is no shade on Xero. I think this is pretty solid product development. I think what they've done and the way they've thought about how it should work from a UI perspective is really solid. I think that there's a lot here that probably will speed up people's usage of it, will speed up the particularly small businesses' usage of the tool. But I don't think it's sort of the death knell for accountants or even really, I think, a huge structural change in how we interact with those. Because the reality is, companies like Xero are responsible for startups being able to automate a lot of things like payroll and stuff like that for a long time now. That's been the case for certainly since I've been running the company. And we already only go to a kind of outsourced accountant, certainly in the early days. These days a bit more, but when we had something pretty specific or something pretty technical, like options or something like that, where we really needed kind of best advice. So the jury, I think, is out on how fundamental the change it will be. But yeah, potentially a lot to look forward to.
Yeah, and I got a similar feeling about this, which is, is this just a new UI on top of existing services that you can kind of get in Xero? Instead of using my mouse to, navigate to the bits that I know I can navigate to, writing a prompt to surface those insights, I think is kind of the question. And is that AI, or is that just kind of a new user interface? Is a question. The other one that I had was, I could see this being really useful for someone like me who is not an accountant and has never worked in a financial department before. And maybe there are occasions where I'm, where I want to query this information in a way where, I'm asking the questions that I know to ask, and receiving information in however it's kind of being presented to me using the data set that it sits on top of. But my general experience is that if you're at the point where you're using a platform like Xero, there's generally going to be someone there, either they're a full-time employee of yours or they're a fractional finance person of yours who is using that product. And therefore, I'm kind of thinking like, I don't know who it's really I don't really know who it's for. And, maybe it's because I've not used it, and, it's probably not for me, just because I don't really get stuck into Xero. But I think Mike's point is interesting around separating the PR bits from the genuine innovation. And maybe there is genuine innovation here, and I'm not necessarily seeing it. But yeah, I got a question mark on this one, I think.
Okay. Matt, what's your take? Question mark or more positive?
Probably the same, if I'm honest. We've seen a pretty public display of somebody in the public eye this week getting inaccurate advice and ending up causing them a considerable problem when it comes to finance and accounting and tax. And I agree with Mike, right? If there's a big trust layer here, if you get something wrong from a SME accounting or reporting perspective in the UK, you can ultimately go to prison. So it'll be interesting to see how it evolves. But to Jamie's point, is it a window dressing above something that's already there? I don't know the answer to that question, but it might well be.
AI glitter, as Mike called it, which I really like.
Yeah, I like that a lot.
Well, I think the challenge is if you're a company like Xero, you need to have an AI piece, because the other side of it is I think there will be people out there who will be taking their spreadsheets and they'll be uploading it to ChatGPT and they'll be asking, do you have any news for me? And I think that's not great either, because, there's a huge amount of data there which you lose control of very quickly as soon as it goes into one of those ecosystems. There's no real understanding of the UK regulatory picture from these companies, and I speak of that as someone who interacts with them a lot. They're often US based. They have quite a different perspective on moving fast and breaking things, and so it makes sense for someone like Xero who's going to have a lot more of understanding of those concerns, who's going to have people who are going to be able to do that, to bring it in house, to put something in the tool. I think that's a good step, but I think it's hard. Somebody who's spent the last few years looking at the AI developments and thinking really seriously, okay, I understand the technology, but understanding how that's actually going to change things, it's really difficult to predict because a lot of the industries it's disrupting, I think, they have regulations, they have friction that is not there just to make things slow. It's there to provide protection. It's there because they're mature industries that have built up these systems of governance over hundreds of years, and I think that's not going to, for all the excitement that the AI brings, and it does. I'm still very excited. I'm CTO of an AI company after all. I think
if you weren't excited, you're in the wrong job.
Exactly. No, it's one of those hard positions to take because I think as soon as you understand the technology, you understand what it's actually capable of and the limitations. It's a lot more of a tricky line to thread to see exactly how we're going to use it, exactly how we're going to get the most out of it.
Yeah, that's such a good point. And also to your earlier point as well, that kind of Xero have to kind of employ an AI strategy at some point, because otherwise their customers are just going to be using AI in a potentially less informed way anyway. But yeah, we will keep an eye on this one and see how it develops. And on that note, we're just going to take another quick pause here, back shortly. Okay, now for a quick look at one more newsworthy story this week that we don't have time to cover in full, but we think you'll find just as interesting. And that is that UK open banking hits 15 million users. The story was on payments. Over 15.6 million people and businesses in the UK now use open banking services, nearly 1/3 of all UK adults. In July 2025, open banking services were accessed a record 2 billion times, marking a 3.5 increase from June. Active users have risen by 34% over the past year, highlighting rapid adoption. Open banking is increasingly embedded into everyday UK life, from paying taxes to shopping, thanks to its speed, security and trust, according to Open Banking Limited CEO Henk van Huel. The recent Data Use and Access Act is paving the way for the next phase of open banking, along with expanded open finance and smart data initiatives in the UK. So my thoughts on this. We cover these stories occasionally of these milestones. Is 15 million an impressive number? Well, I kind of ran some initial maths on it. And maths isn't my strong point, so apologies if these numbers are very rough. But if we're looking at a sort of UK population of 70 million, average adult population about 50 million, and 15.6 of them are using open banking, 1 in 3 actually isn't that bad. And especially with an aging population and an increasing number of that adult population may not be tech savvy, still that 1 in 3 is sounding pretty good. Equally, I looked this up, and the last time we covered this milestone on the show, open banking in the UK had reached 11 million users. But actually, that was only back in June of this year. So open banking usage in the UK has grown by over 4 million users in 3 months. And to me, that's actually the more impressive number, the speed and size of the adoption in those 3 months. Open banking has kind of always had a reputational issue. One of our hosts, Benjamin Ensor, has written a whole research report on that in partnership with Go Cardless, and perhaps is missing that one killer use case, such as a direct debit to pay bills, etc. And has maybe sort of struggled to get going since it launched in January 2018. But clearly, its value is starting to syndicate out. It's being used for more and more things, as we just said. And people are actually trusting their banks and third parties enough to share their data across both parties, and adoption is clearly ramping up. So it'll be interesting to see if that J-curve keeps going and to see where it's at in another 3 months. Could it be at 20 million? We will find out. And finally, now time for something a little bit lighter, both figuratively and literally, to finish this week's news show. And the headline came from The Sun, so, forgive me. CHOCCY horror, Quality Street Christmas chocolate tubs shrink again with 6 fewer sweets. So, for our international listeners, the tub of well-known British chocolates known as Quality Street that traditionally comes out at Christmas has since announced that it's going to be decreasing from 600 grams to 550 grams, now containing approximately 57 chocolates compared to around 63 last year. Despite the smaller size, the tubs will still cost roughly the same, around £5 to £6 in supermarkets, and over the last 10 years, the tubs have progressively shrunk from 780 grams to 650 and now to 550. And Nestlé cites rising manufacturer, ingredient and transportation costs as a reason for the smaller tubs, while still claiming that the product offers good value. Shrinkflation is something we've discussed quite a lot on this show recently. People getting outraged about shrinking size and increasing price of Freddos, likewise meal deals. Now we're on kind of Christmas classics. Obviously, we know we're in autumn when we're starting to discuss Christmas chocolates. What's your guys' take on this?
We're really plumbing the depths, aren't we?
Yes.
My feeling on this from a kind of startup perspective is that on the long run, that this will be good for startups. Maybe I need to justify that. But I think, increasingly we're seeing the shrinkflation. It annoys me. It annoys me hugely, and you see it all over the place. And if you actually look at the stats, I think that it's well above, the corresponding inflation in the raw goods and the labor. The amount that ultimately consumers have basically begun to be overcharged by. But my feeling, and maybe this is with all the lack of knowledge of someone who's not directly involved in the industry, but my feeling is then that there isn't the competitive pressure on these massive, very long established brands to stop them doing it. And I guess the counterpoint to that is then when there becomes a kind of a vacuum like that for competitive pressure, that's an opportunity for startups. And in confectionery, I mean, the ones that come to mind for me are a lot of the, like the vegan-based sweets. You see things like Candy Kittens, things like that. Lots of these smaller companies, but growing. But then obviously they get snapped up. But I do think that if there's a positive to it, it's that I think. I don't know. I think increasingly these are deals that the consumers are just not going to go for. I mean, if you go on Reddit now and you put in things like Quality Street, you already hear about how much palm oil is in it now these days, how rubbish the chocolate tastes compared to what it was that we remember even from 15 years ago or something. My view is it's not sustainable.
How little cocoa is actually in there as well. They're putting like 49% carob or something, just enough to say that it's still.
I was not expecting this to bookend the fintech discussion. Mike, you did an excellent job of segueing a discussion point about Quality Streets into some sort of startup analogy and what founders could learn for it, which, it's got the makings of an excellent LinkedIn post, if I'm honest. For me, number one, who cares about Quality Streets? They're awful. Nobody eats them anymore. They're rubbish. The second is, it's a crying shame that we can't be more present as a society and not be focusing on Christmas chocolates on the 4th of September. Like, let's be in the moment now. That applies to all startup founders. That applies to my children. That applies to everybody, all the human race. Let's be more present. Let's not worry too much about Christmas. And there really is only one Christmas chocolate that everybody should be worried about, and it's definitely not Quality Streets.
And it is instead
100% Terry's chocolate orange.
Yes.
Oh, good
No
choice.
shrinkflation.
Thank you.
No shrinkflation there. It's always looked like an orange. It's always been the same.
I've won 5. I got another thought as well, which I think we should all just spend a little bit of time thinking about the intern who every year the editor turns to and goes, you got to count the chocolate out this year. You got to dig out the news story from last year. You got to do the arithmetic. How many fewer sweets have we got in the box this year? And I want that on my desk in the morning. So let's all just have a moment of
Nestle
silence.
haven't had a good week, right? Nestle has not had a good week. And we've piled on unnecessarily with a story about the fact that, shrinkflation is now happening to their Quality Street party mix.
Hang on, what's happened to Nestle this week? I've missed that.
It's been a slight CEO upheaval.
Oh, God, yeah. Yeah. Another Coldplay style incident. Is that right?
I can't comment, but it's not been a good week for them.
But the more I think about it, the more this is such a great story, because the point that we made earlier about British, UK businesses, for example, being bought out. I mean, chocolate is all about that, isn't it? Fries, Kit Kat was originally like a UK, now it's owned by Nestle, and then like Hershey's in the US. Or Cadbury famously has been bought up.
I'm imagining
the story of.
I'm imagining the edit of this episode is just a really slow volume down of us having this conversation, which implies that it just goes on
I
for
disagree.
ages.
I am very much enjoying Mike valiantly trying to pull it back to focus. So I'm going to end the show soon. However, despite Matt's protest that we should focus on the present and not be worrying about Christmas, he's equally given us an impassioned plea for his favourite Christmas chocolate. So we know that that's the chocolate orange. Jamie, what would you say yours is?
My favourite Christmas chocolate? I mean, anything that comes out of an advent calendar, I think, tastes different.
Yeah.
Maybe it's because you have it at like 7 a.m, but I like at the Christmas, I quite like that.
Nice. Mike?
I'm going to out myself as a foodie now, but Montezuma's do like these peanut butter.
Oh, amazing! The big buttons.
Oh, well, they do the big buttons, which are amazing. But the peanut butter, like chocolate covered peanut butter balls. That's where it's at every Christmas.
It's the Rolls Royce of chocolate brands. That is.
Wow.
You've got expensive taste, Mike.
Very nice. For me, I would go a bit more basic. I would go like the Lindt, Santa, or the like Lindt snowman that they do. But it has to be them, not the Lindt balls. They're too sweet, not them. Proper Lindt chocolate. That is the way forward for me. Listeners, please do get in touch, maybe closer to December, with what your favourite festive chocolate is. And on that note, that wraps up today's Fintech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about you and your companies? I think, Jamie, you already gave this plug earlier in the show, but I'm going to give you a shot at doing it again.
Well, you can just reach out to me on LinkedIn, Jamie Campbell. 11FS will probably return me. So yeah, reach out there.
LinkedIn. Okay. And Matt?
You can find me on LinkedIn, Matt Cooper, not the other Matt Cooper that's also in Fintech in London. That confusion happens a lot, unfortunately. And you can head over to Crowdcube. We've got tens and tens of amazing investment opportunities on there at the moment, and we're going to have a super busy September with some incredible growth brands offering you the chance to buy shares in the business. So pop on over there.
Fantastic. And Mike?
Yeah, we're at multiply.ai. And I'm always available at mike@multiply.ai. Always up for chatting about AI more generally. We do a lot of talks. We do a lot of more general stuff that's not just about our business. We run a whole bunch of talks with Google every quarter, so check out those. Always excited to talk about where the world is going. It's a really exciting time for AI, despite some of the things that I've said today.
Fantastic, thank you. As for me, you can find me also on LinkedIn or 11fs.com or on this podcast. So thank you so much for listening to today's Fintech Insider. If you like what you've heard, please make sure to follow us on your favorite podcast platform of choice. If you really like what you've heard, please do share it around with colleagues and friends. And as always, if you want to join the conversation, find us on social media. Just search for 11fs or Fintech Insider, or you can email me and the team at podcasts@11fs.com. Thanks again, and goodbye.
That's the sound of the fully electric Audi Q6 e-tron and the quiet confidence of ultra-smooth handling. The elevated interior reminds you this is more than an EV. This is electric performance redefined.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.